Got just around a minute and a half here until the closing bell. We have full coverage for you this afternoon. We have Rhea Thomas of Wilmington Trust, a senior economist there. We also have Jon Adams, BMO's Global Asset Management senior investment strategist. And let's take a look at where things stand here with just around a minute to go until the closing bell. We haven't seen a heck of a lot of movement in the final couple hours of trading. The Dow trending just along. Now it's off 123 points, so bouncing back a little bit, just off its lows of the day. The S&P off just by a fraction here. It could still turn positive in the final minute of trading. NASDAQ, on the other hand, holding on to gains. It has been the outperformer for the entire trading day and now up just around 0.5%. Taking a look at some of the individual movers in the markets today, looking over at the Dow, the worst performers in the Dow, Caterpillar, that stock off just around 2%. Merck and Dow Inc. are also among the biggest laggards there. United Health and Travelers rounding out the 5 worst performers in the Dow today. Taking a look at the sector action here, worst performer is materials, the XLB off just over 1%. We're also seeing some underperformers in financials and industrials. Flipping over, though, to what's outperforming, why we aren't seeing broader losses here today. Real estate is the biggest outperformer today, with that sector up just around 1%. Communication services and healthcare also holding on to gains.
And there is the closing bell. When we get the gavel, we're going to see where these markets could settle. As you heard Shauna say, it appears that the Dow was pulling off of the session lows, but where it settles is going to be in the red. Right now, the Dow looks like it'll settle around down 127 points. The S&P 500 off by about 3 points. NASDAQ will be up about 67 points. And just looking at some of the action today, you heard Shauna talking about the losers in the Dow, but want to bring your attention to what's going on with Apple. Apple will most likely settle essentially flat, slightly to the upside today. And of course, the Worldwide Developers Conference is underway. You can read all about it. Dan Howley's got the articles up on yahoofinance.com. But let's go to our guests and start breaking down where this market might be headed. And Rhea, I wanted to ask you, we had a guest on in the last hour who was saying, look, this summer, we're just going to keep going sideways. Can you make an argument as to why that might not be the case, or do you agree?
Well, we actually have a view that equities will continue to outperform bonds over the next 9 to 12-month horizon. And we've been positioned with an overweight to equities since November of 2020 and an underweight to investment-grade fixed income since December. And we've actually taken an additional step in that direction just last month by increasing our position to international developed equities and reducing some of our positions in investment-grade fixed income. And that's because we believe that the stronger growth outlook going forward will come with higher inflation as well as higher interest rates. But we do expect that the Fed will not be in a rush to reduce accommodation. And we think all of those factors will be supportive of that type of portfolio positioning. So we do expect equities to continue to outperform bonds going forward.
John, what do you think? Do you agree? And where do you think we're headed in the short term?
Sure. Yeah, we're also pretty constructive on the medium-term outlook. We think investors are getting a bit too pessimistic as far as the outlook, given inflation concerns and the increasing tax environment. We think that the backdrop of a very supportive policy environment, strengthening economy, and very strong earnings momentum really portend gains for equities as we head toward the second half of the year. We really prefer to position investors toward value with a tilt there, a tilt towards small cap. We think those areas of the equity spectrum perform well in rising inflationary periods. But we think that equities are a pretty good hedge against potentially higher inflation. And we're not as worried about the corporate tax environment, given kind of the headlines here over the last week or so.
Well, John, you also have said that you're not too worried about inflation being anything but transitory, as the Fed keeps telling us. So if you agree with that, for investors who might have a risk tolerance and be able, constitution strong enough to deal with higher yield fixed income on the corporate side, even if the companies are a little shaky, is now the time to consider that, or would that be a warning to them? No, don't go there.
Yeah, we don't find as much value in investment-grade corporate, given where spreads are kind of below pre-pandemic levels currently. We find a bit more value in areas like high yield, for example, but we really prefer to take our risk through equities. We think they present the best risk-reward profile for investors at this point, and there is room to run. In credit, we think the risk is a bit more asymmetric and more of kind of a coupon clipping type of environment with spreads at relatively low levels overall.
All right, we want to head over quickly to Jared Blickery, who's standing by on the floor of the New York Stock Exchange. Jared, for your final word, what do you have?
CPI print on Thursday morning. I think that's going to be a huge catalyst this week. We're just talking about inflation, the importance of this number to market participants. And I think the true test is going to be inside the 10-year yield. You have the break-evens component and you have the real yield, and the break-evens are knocking on 2.5%. If they shoot above, and that's a really big level, probably could see some trouble, I would say, with equities or for equities. And if it just kind of bounces out or heads down, then really not a blip on the radar. Fed's not going to say anything about it this week because they're in their blackout period, but they're going to deal with it next week. And just let's remember that the last time we got a really hot CPI print, the market did sell off a little bit.
All right, Jared, thanks. Rhea, what's your view just on inflation in terms of your expectations? I was looking at your notes. You expect it to be transitory, but anything on your radar that could potentially change that view?
Yeah, we think there are two important things to watch on the inflation front. Again, our view is that the move right now is transitory. It's driven largely by base effects, by sort of these supply chain disruptions, as well as the reopening effects, where you have big price increases in some areas of the economy that are still playing catch up. Things like airfares, for example, where they're still not back to pre-pandemic levels. But we do think it's important to watch bubbling wage pressures, as well as inflation expectations, longer term inflation expectations in particular, because we think that the Fed will be watchful of those because those will potentially signify kind of more persistent upward inflationary pressures. Right now, inflation expectations have moved up, especially the longer term ones, have moved up to sort of these levels where we were prior to that 2014, 2015 drop in inflation expectations. And the Fed actually modified their monetary policy framework in order to kind of nudge those inflation expectations up to where they are right now. But if we move persistently higher from where we are now, that may catch the Fed's attention, in our view, and be a little bit more worrisome.
Rhea, given that, why did you guys put a little bit into cash?
We do think that it is appealing to have that position there so that we can deploy if there is some type of pullback in equity markets going forward. But right now, our primary positions are really, our heaviest positions are really in international equities, where we do think there is a bit more room for that rebound, that lagged rebound in those international economies to catch up with what we've seen here in the US. And that's really where we're most heavily positioned in the equity space.
Jon, when it comes to potential policy changes that we could see here, take a look at the global tax reform and also some of the other initiatives that the Biden administration has laid out, how much of that is already being priced into the market?
I think a lot of that is being priced, and it's been well flagged for quite some time. We've been advocating the fact that investors shouldn't look at the headlines. They should look at what's actually likely to get passed. I think if you look at what we've seen over the last few days, we've seen kind of some of the momentum behind increasing corporate taxes subside to some degree. So our base case was maybe a 25% level in corporate taxes. It's possible we might not even see corporate taxes increased at this point, depending on how the other talks go over the next couple of months. So we are watching it closely, but again, we think there's a lot of momentum behind the economy and the equity market and can withstand any potential policy changes. And the Fed's going to err, we think, on the dovish side. You're still going to see a lot of fiscal stimulus, a lot of infrastructure, regardless of what the top line number is. A lot of the previous stimulus is still working its way through the system. So we think that there's really, on a medium-term basis, a lot of momentum behind the economy.
All right, Jon Adams, BMO Global Asset Management, and Rhea Thomas of Wilmington Trust. Thank you both for joining us here today.